Welcome to Stock Market Risk Explained. There are two types of stock market risk. There's stock-specific risk and systematic risk. Let's start with stock-specific risk. Stock-specific risk is risk that only affects one individual company or stock. And stock-specific risk can be diversified away. That is very critical for you to understand. Stock-specific risk can be diversified away. Let's take a look at some stock or company-specific risk examples. Now, these are just a few of the examples, but these are things that can happen. So maybe the sales slow down or decrease in a company. Now, the difference there, let's say that the company was growing their sales at 10 or 20% a year, and all of a sudden they slow down to only a 5% year-over-year sales growth. So that in and of itself could be a risk to the company. So they're still growing their sales, but the sales are growing slower than what they have been in the past. Now, if the sales were to decrease, so maybe they sold $1 million worth of product last year, and this year they're only going to sell maybe $750,000 worth of product. So they're still selling product, but they have actually decreased year over year as to what they're selling. So either one of those things, either a slowdown in the sales growth or an actual decrease in sales, could have a material impact, a negative impact on the stock. Also, earnings could decline. So maybe the earnings are declining because of slowing or decreased sales, but the earnings could also decline because of one-time expenses that came up, increased expenses. But again, maybe they made $2 a share last year, and this year they're only going to make $1.50 per share. I'm just giving you examples here. But that would be an earnings decline. So it doesn't mean that they're losing money, even though they could, right? But it just means that the earnings are actually declining, which again could be tied to a sales slowdown or a decrease in sales, or it could be tied to something else, irrespective of whether the sales are slowing down or decreasing. Also, you could get credit downgrades. Okay, so one of the major credit agencies look at the credit of the company and they downgrade their credit worthiness. That could be a stock or company specific risk. Also, analysts, right? And these guys are just, people that look at stocks. They're employed by some of the big companies perhaps, but analysts could look at a stock. And I've had this happen so many times, I can't even tell you. But an analyst can come out, take a look and say, well, I'm going to downgrade this company. I don't like it. I'm going to downgrade it from a buy to a hold, or from a hold to a sell, or from an outperform to a market perform. So these are all just different levels that the analysts use. And whenever there's a downgrade, it doesn't mean that the stock is bad. It's just one person's opinion. And in most cases, probably 9 times out of 10, whenever I've had this happen to me on stocks that I've owned, the analyst was not right. Okay, but at least for a short period of time, it can be days or weeks, that downgrade can really hit that stock, or the analyst makes a negative comment and the stock goes down. So these are, again, stock-specific risk examples. Another example could be the CEO or a key executive within the company either departs, maybe they passed away, that happens, they get fired, they leave for another job, whatever, they leave for health reasons, or there's negative news about the CEO or a key executive, right? So something happened, maybe they had an affair or whatever. These types of things oftentimes can have an impact on the level of the stock. So again, these are stock or company specific examples. Also, there could be a product recall, or something went wrong with the service of a company. Okay, so negative news around the product itself or the service of the company, those things could be, again, another example of stock or company specific risks. And guys, there's many, many more, but these are kind of the major ones that you're going to contend with on an individual company basis, on a stock specific basis. Now let's turn our attention to systematic. So systematic means the system. In this case, it's the whole stock market. So systematic risk is also known as volatility or market risk, and systematic risk affects the entire stock market, not just one stock, industry, or sector. And systematic risk is undiversifiable. Okay, systematic risk. It's so important to understand this. Systematic risk is undiversifiable risk. You cannot diversify away systematic risk. And this is where I think most people, there's a huge disconnect. They think because they're diversified, they're fine. Okay, and I'm going to show you some examples here to illustrate the point. Now, what we're looking at here is the chart, a 20-year chart of the Wilshire 5000. Okay, so this goes clear back, and I'm going to use my cursor now. But if you look over here on the left-hand side, you could see this is 2000. Okay, to current. Making this video on November 1st of 2019. So when you look over here at the end of 2000, beginning of 2001, you can see that the Wilshire 5000 peaked at around 15,000. Okay, and then dropped all the way down to about 7,500. Okay, so this right here, guys, this is what we're talking about. This is systematic risk. It's volatility. It's market risk. It's all the same thing, just different ways to say the same thing. And by the way, the Wilshire 5000, and the reason I'm showing you this is when it was originally constructed back in, I believe, 1974, it was designed to have 5,000 stocks in it. Now, that is a ton of diversification. Over time, it's had as many as, I think, 7,200 stocks in it at one point back in the late 90s. As of late, it has less than 3,600 holdings in it. And that's a video for a whole nother time. I'll explain why. So look for another video on that over the next few weeks or months. But because there's some interesting reasons why this has happened. But basically, the Wilshire 5000 represents the entire U.S. stock market. Okay, so even if you own the entire U.S. stock market, in this case, almost 3,600 individual stocks, you still cannot diversify away this type of a drop, this 50% drop that we would have experienced in 2000 through the beginning of 03. Okay, and then you climb back up. You get almost exactly to the same level in the Wilshire, just a hair higher. In this case, we got clear back up to about 16,000, as you can see right here at the end of 07 on the Wilshire 5000. And over the next year and a half to the beginning of 2009, it fell way below. And if you can see where my cursor is over on the right-hand side, the price level under 7,000. That is, I'm just going to ballpark this, guys, but that's about a 60% haircut that we took there, 60% fall, okay? So here, 2000 through the beginning of 03, that was a 50% decline. Excuse me, on the Wilshire 5000, and here that's over a 60% decline. Okay, this is what we're talking about. This is market risk. This is undiversifiable. You can own, in this case, the entire U.S. stock market, and you still cannot escape these types of drops. Okay, now on this next chart, let's take a look at the S&P 500. You can see it's virtually the same thing, and most people these days have exposure, or a lot of people, I should say, have exposure to the S&P 500, and that is absolutely fine. In most cases, and I am not making recommendations, but in most cases, this is all you need. You don't need anything more because the S&P 500, and by the way, I have another video on this, so look on my YouTube channel. It drills down on the S&P 500, the construct of it, but the S&P 500 is called the S&P 500 because it has 500 stocks in it, okay? But you don't need anything more than this. It's probably more than what you need, but the reality is it's easy for most people to own this thing these days, and whether it's via an ETF or a mutual fund, it doesn't make any difference in your 401k, IRA, whatever. But the point is, you can see that the chart looks very similar to the Wilshire 5000 chart, okay? And you're subject to those same types of 50 to 60% or so declines when we hit these major downturns in the stock market. So diversification, and we just saw it on those last two charts. In one example of the Wilshire 5000 having about 3,600 stocks in it right now, and then the S&P 500 having 500 stocks in it. Diversification reduces stock-specific risk. Again, go out and watch my video on the S&P 500 to get a little bit better understanding of that. But diversification cannot do anything about systematic risk. Okay, diversification reduces stock-specific risk. However, systematic risk remains. Hey guys, systematic risk, market risk, it's the same thing, right? Systematic risk is the fancy way. It's the industry term for this, but market risk is fueled by increasing correlations. Now stay with me here, but let's first off review the definition of correlation. Correlation means a mutual relationship or connection between two or more things. With respect to stock market correlations, most equities, and we just saw this on the Wilshire 5000 and the S&P 500 on those 20-year charts, that most equities will go in the same general direction, both up and down. That's correlations, okay? So most stocks follow the general direction of the market. The rate of change will vary, but they generally will go in about the same general direction. But here's the thing. Correlations increase with rising volatility. Said another way, correlations increase as the stock market falls. Let me repeat that. Correlations increase as the stock market falls. It's super important for you to understand this. One of the best ways I've ever heard this said is, in times of rising volatility, more and more stocks and asset classes become highly correlated. And you saw it on the charts here, guys, but the stock market takes the stairs up and the elevator down. All right. It takes the stock market goes down a whole lot faster than it goes up. So it takes a long time, right? It takes years and years and years for you to make progress. But in a very short period of time, you can lose, 5, 6, 10 years of gains in a matter of a year or two. Okay. So the stock market takes the stairs up and the elevator down. Systematic risk management, okay, market risk management is critical. It's the key. It's the secret to long-term profitability and success in the stock market. If you want to learn more about how you can really understand market risk, volatility, systematic risk, and what you can do about it, I highly, highly encourage you to watch my Successful Investor webinar, which you will find on my YouTube channel. I will also leave a link for that webinar in the description box below this video. But I would highly encourage you to watch this webinar. It's a little less than an hour long. Let's just call it an hour. Guys, it's going to be one of the most important hours you've ever invested in yourself when it comes to your finances. I promise you. It is packed full of all kinds of information. I probably put too much in that webinar, okay? But I want to share with you. I love helping people. I love educating, and it's my background. I've spent the bulk of my adult life in the financial services industry and working on understanding and being able to gauge market risk and then what we can do about it. And it's a tough problem, but I figured a few things out, and I'll share those with you on that webinar. So your next steps. Watch my Successful Investor webinar, watch my other educational videos on my YouTube channel, subscribe to my YouTube channel for ongoing education. Please give me a thumbs up on this and other videos if you like them. Leave a comment on my videos and share my videos and my YouTube channel with your friends, family, and colleagues. And please feel free to connect with me on social media. Just Google my name and connect with me on social media. And folks, thank you so much for being on this video with me. I really appreciate it, and I look forward to seeing you on the next video.